Okay, so we're going to do a close proximity bullish breaker entry, and I'm going to execute now. And we'll use stop loss of 55. Take profit of 114, big figure. Okay. And what we're doing is we're capitalizing on the run on stops here. We're entering. Inside of this candle here. Shade that a different color. So in here, looking to go long with the expectation that we're going to clear out all of the liquidity above these highs. And if we do a 10 pip okay, it's 10 pips, and then we'll do 20 pip. And then we'll do a 30 pip grade. And we'll scrunch this down a little bit. Okay, and here they are respectively. And the point of this exercise is we know there's a strong likelihood that we'll have a run on the liquidity above these highs. You want to be engaged in the price action, watching its sensitivity, its willingness to want to move above these highs, and you want to enter right in this candle. What this is going to do is it's going to teach you tolerance. This isn't exactly as I'd like it. There you are. Bring that down there. All right, so we have stops in here. sell side liquidity. In here. Now this is a rejection block, and if you don't know what that is, you'll see that in the future content. Okay, so price trades into the block, hits it, runs, expands. Huge pool of liquidity resting above these highs. Again, we've mapped out the 10, 20 pip and 30 pip grade of stop sweeping we would expect in here. Okay, and I have my limit order to get out at the big figure and just ahead of 30 pips. Now it could go more than that because there's been a decoupling of the euro and cable. I'll take a quick look at cable. You can see beautiful upside as we expected on this particular pair. Let's go out to an hourly chart. You can see a little bit more framework here. Okay, you can see that we have cleared an area of liquidity here. It continued on higher. We mentioned previously this week on Monday that we would see upside runs on liquidity. On a weekly chart, we said that we would probably see some inefficiency up here in the breaker be a factor. We have a really nice strong showing thus far for this week. The range is open at 28.50 with a high of 30.63. So we've seen over 200 pips of a move. Again, I mentioned that if you're going to trade this, you need to do it deleveraged. That means you're not going to be exposed to unnecessary risk. And our dollar index, we have a large liquidity pool here, relative equal lows. Multiple times trying to go higher, rejected that, so they're going to want to rebalance down here. We have two areas to concern ourselves with from a intraday basis. We have our buy side imbalance, sell side inefficiency here. And we have another one right in here. Right there. So we'll look for these to be traded into. Just as a point of additional reference, we're going to add the average daily range suggests a deeper run, and that would take us below this low in here. I'm not going to be that demanding in terms of what the dollar may do today. I think that these two are likely. This one highly likely because we have an 80 level, essentially 95.80. I want to see if there's any rejection in here once we clear these areas of imbalance and price has been offered on the sell side. Once that occurs, this area up here would be a point of interest, but we'll have to see when and if we trade down here at all. Going back to the euro dollar, what I'm mentioning earlier was when we look for exercises, and it's all this, it's not a like get wild and go crazy and try to over leverage the account and all that. The premise is once price has shown a willingness to want to run the stops, and that's all that's necessary because everyone's spread's slightly different. And if you don't understand what I mean by that, be long. Be long here with a stop just at that low or just below it, and believe me, they'll open the spread to get you. That's what you agree to when you open up an account. So inside of this up close candle, this is our bullish breaker. I'm entering with the premise that this will eventually trade through, and it can, and I'll permit it to, trade back into this up close candle and find support. It would be better if it didn't do that, but that's what we're trying to do. At first glance, this would look like chasing price because the context has not been outlined as I'm doing it now. It's relatively low in terms of risk. I mean, we're talking about very, very small, tiny little risk in terms of equity and also pips. It's less than 15 pips. I know it says negative 143, but they show it in pippets, so it'll give that additional digit. So it's less than 15 pips of a stop with the likelihood of making a run up to the big figure, which would be 30 pips or more, a little bit more than that. So it's a nice little low resistance liquidity run relative to the equal highs in here. Lots of pulling buy side liquidity. So there'll be a lot of folks that want to buy this on a breakout. Shorts have their buy stops resting above there. And again, we're close to the 113.80 institutional level up here as well. There'll be transactional order flow at that price point as well. And if we get that, we may expand up into 114 big figure. So again, what this exercise teaches is tolerance. That means sitting in a trade that has already started to move. Ideal entry is obviously down here, but we don't need that. We do not need that entry point. You need the context in the price. What is price likely to do? Now see, watching it in here, you may feel, if this was a live account or if you've executed yourself, you may feel some uncertainty or some apprehension in whether or not this thing's going to go higher or lower. You feel that, and that's what you need to do. You want to be practicing every single day, engaging with the things that you learn in the mentorship. The only way you're going to develop your eye and your experience is by doing it. And I can't transfer my experience to you. It has to be accumulated on your own. So while price is up here towards the top end of this range, the expectation is the open float is the buy side liquidity right above here. That's going to be tagged or reached into. Now, on the downside, how far can it retrace? Ideally, you want to see it stay inside of this area right in here. Why? Because that's the last up close candle. They sold into it here, it ran stops. So our premise is they came down here and knocked those individuals out before the big move or the underlying move for today to the upside would be seen. And since it's an intraday volatility exercise, it can be against the weekly analysis. In other words, longer term, euro dollar could trade lower, and this could still be insignificant in the grand scheme of the longer term view. So this would, allow you to capitalize on the opportunity to engage, get experience, test the theory of open float, looking for liquidity, getting in an area where it's logical, even though it would not seem logical in the sense of a retail trader. For instance, if we pulled up an indicator and we looked at, for instance, relative strength, and we'll use a 14, we'll plot that with a line here. Okay, we're like in no man's land for oscillators. It's towards the end of the top end of the range that's being shown here. So in other words, if we looked at the range created by this RSI, the highest range is essentially there, and the lowest is down here. So that's your oscillating range. So we're above midpoint. So in essence, this would be deemed overbought, even though it's not technically at the 70. So retail wouldn't necessarily see this as a buy, but from an institutional standpoint, none of this stuff down here makes any point in terms of what price is going to do. No, it doesn't predict prices, put it that way. So we're focusing on the order flow that would reside in here. They're building up more longs. I wouldn't be surprised if we see it shoot down and touch the bottom of the range. That would be permissible, but still upside expansion would be the intended outcome. So I'll let this recording go a little bit, and if there's something to talk about, obviously I'll mention it in passing. Time is 10:18, Wednesday, January 23rd, 2019. So we have a little bit left in the daily range. This may be a late bloomer, consolidation day, and again with the cable tearing to the upside like that, Eurodollar may want to make an attempt to rebalance and get in sync with it, since we've seen the consolidation effort on Eurodollar and the trending model that cable's in. Dollar index is yet to break out of its little range in here. Again, open float, the liquidity resting below these equal lows would send us into these areas. We've had 1, 2, 3, 4 times trying to trade higher. We broke down. We're in consolidation. I don't see that as a reversal, but I do suspect that we could seek this liquidity down here. And I'd like to see it come down here, pick these orders up, and then continue on the upside. So again, we'll go back and resume our observation on the Eurodollar. Now you would be wanting to log all of these feelings you have as we start to see it have a closer expansion down to the end of this candle's low. And you want to desensitize yourself by watching this. And you can see how quickly we're giving it all back. Again, this exercise is tolerance. Okay, there's things that I'll put you into and suggest to you that you practice with. And again, the intention is not necessarily to grow the account. It's to desensitize yourself to certain characteristics of price action within a underlying premise. So the premise is we think it's going to go higher, or I think it's going to go higher, to seek the buy side liquidity. The trading against the entry, and we use the high end up here of the range, just outside of the bullish candle because of the spread. That's what's been shown here, but technically we're inside a candle. The fill is near the top end of the range, and we want to watch how price trades into the bottom of that candle and see if there's any sensitivity to that. If it does, it starts to show upward momentum, then we can start to look to reduce the stop. And again, you're building tolerance in price action that is against or opposed to your underlying entry, using the worst case scenario entry point, but still working within an underlying premise. All of these things will help build your model that will lead to precision, even though this isn't precision in the sense that look how tight the entry was to the actual lowest low and the exit being near the highest high. That's not the premise of this exercise. What you're teaching yourself is to be completely void of any emotion. You're not worrying about whether or not it's going to trade outside that range. You want to see how many times it does this. Okay, by doing exercises like this, there's many opportunities. This is a 15-minute chart. You can do it on a 5-minute chart. You can do it on 1-minute charts several times a day. There's across the majors. You can do Eurodollar, cable, Aussie dollar, New Zealand dollar, dollar CAD, dollar yen. Since I hate that pair. The exercise can be done several times a day. All you're doing is looking for where the open float is above the marketplace, what liquidity would rest above that, and what liquidity would be resting below the marketplace. And you want to try to get in at the worst entry point and then watch it, study it. And by doing it, it completely desensitizes you to what price might do against you. And you won't fear being in your positions, because there's one thing about speculating and trading is the discounting that authors and educators do about the wearing down of the patience factor in a trader. And the reason why is because most of them aren't real profitable traders, and they don't have an arsenal, if you will, of exercise is to help teach students or teach traders that have yet to find consistency how to overcome that battlefield in your mind, because that's where 90% of this is going to come from. Your ability to stay with a trade idea, because anyone could quickly look at a chart and think, well, okay, it's going to go up, it's going to go down. Okay, that's fine. That's assuming that we've done the same thing here. We think it's going to go higher. Run the buy side liquidity. It can go 30 pips, but we're going to try to take something off at 10, at 20, and ultimately see if we can get to that upside objective for a full haul at 30 pips. If we get the movement contained inside that single candle and the exercise pans out to hit the 30 pip run on liquidity, what that'll give you is experience, number one, to trust the fact that breakers are in fact a valid phenomenon in price action, and that the algorithm measures the specific price points defined by the last up close candle, its high and low, in context with time and price, which is what we've shown here. We're near the end of the day, so it didn't find its way lower. We did stop out anyone that was long in here, so we had a double run on these stops here and in here. We've essentially traded into the mean threshold of this series of down close candles. Okay, we had this run here, we had this run to it again, we had this one more run lower, and we rejected it, came back in here, and now we're staying inside of this trading range right in here. So if we were to look at, say, a 5-minute chart with this same price action defined in here, this would not look like a buy to anyone outside of our circle, outside the mentorship. They would not see this as a buy, but yet it is. Now, while you're watching price action, and we're towards the low end of this range in here, when we're trading down to this price point here, or even here, this would be an area, okay, this would be a better entry point. We could be entering along here at 113.65, and again, the same stop would be here, and it would be a lower amount of risk, or lesser amount of risk, than the initial entry up here. And you make little notations in your study journal, or do it with your notepad at the time, and then you transfer those notes. Since you're only doing it in bullet point format, we're not doing essays, we're not doing real long paragraphs explaining things. Time when certain things are occurring, like right now at 10:29, 10:30, we observed that price is still being contained in the 15-minute bullish breaker. Price came down towards the end of that range. Again, the range is the low, that 15-minute candle. We came back down, traded into some down close candles. Didn't get to the bodies, but we did trade down into them. So it's picking up more orders. We're not worrying about whether it's going to break out of the range. We're studying, does it have the ability to stay in the range and not go outside of it, and yet still find more orders to push it outside to the upside above here. So we have created another liquidity pool with these equal highs. Even though these slightly little equal highs here have essentially been ran, the larger context is that we've already, on a 15-minute basis, because now what's subordinate in terms of price? Is the 5-minute subordinate to a 15-minute, or a 15-minute subordinate to a 5? The higher the time frame, the parent role is assumed, and subordination is on the lesser time frame. So if we can see and define that there's a large liquidity pool here on a 15-minute time frame, it doesn't matter so much that we have a 5-minute liquidity pool here with equal highs that has already been ran. That's fine. The context now has been added that we have a breaker here. This low has been tagged. We ran up. We're inside of this range. So we're growing in our tolerance. That's the nature of this exercise. It builds tolerance in your psyche and your mindset by watching price. When price is having its wicking formation here, even if you bought up here, or if you have a position that you entered into, it doesn't necessarily need to be the worst case scenario like we're forcing ourselves to do here. It could be a relatively good entry, but you still have some drawdown away from that entry. the common experience, if you will, is that the trader, because there's very little experience, they get nervous. They start wanting to move their stop wider. They're trying to determine whether they want to get out of the trade. All those things are in their mind because they have not built a tolerance to normal price action. The reason why their sensitivity is so high and they have a lack of tolerance and an intolerance to adverse price action is because most of the time they're over leveraging their account. Because the over leveraging factor is at play, the amount of pain that is being experienced is being basically translated to how much money am I going to lose here versus price should stay within this defined dealing range with its last up close candle here. That is our 15-minute dealing range. That's all we're doing is we're dealing inside this 15-minute dealing range. So again, going back to that 5-minute chart, we came back down into some down close candles. So I teach institutional order flow. This is what you would expect to see. Now, if we go down to a 1-minute chart, we're going to look inside this area right in here, and it's highlighted before we do so. So we have all of this price action in here. Okay, so inside the white area that's clearly distinguished from the, I guess that would be tan or beige. The 1-minute chart, we drop down into it. Clearly, we can see now we have a propulsion candle. That's all we did. We traded down to a propulsion. We have a bullish order block right here. Price trades away from that and then comes back down into it. This down close candle that does not breach the midpoint, this is our bullish propulsion candle. When we see that, price trades back down into it again. You should never see price trade down through the mean threshold of a propulsion candle. That's what we see here, price respecting above the 50% level of that. And we came back down and hit it again. All we did was use reclaimed order block theory right here with the context that this whole price move here, and this right here, again, this is even better. Watching the 1-minute chart, we can see it trade down to this down close candle here, and that would be normal. There's nothing wrong with this idea of price action moving to this price point right here. Thicken that up a little bit. And we'll look to see if it can close that. So it's a buy side imbalance, sell side inefficiency inside this range. So we'll watch to see. It doesn't have to do this. It's better if it leaves it because that would be a breakaway gap. Okay, so we want to see price stay above this basically. And there's also essentially equilibrium of the range that we defined with that 15-minute bullish breaker. So we're going to watch this one on 1-minute chart unless we break out to the upside and show some magnitude in displacement. But right now, we're still inside the range, dealing inside of that 15-minute breaker, which is defined by this tan shaded box, if you want to call it that. Now, this exercise, again, it builds tolerance, it builds patience, because once you put your trade on, who's in control after that? The market is. So you have to submit to the time required for your trade to either move to your target or run to your stop. One of those two scenarios is going to happen. You don't know for certain which one it's going to be, but you have to build tolerance to that amount of time, and you also have to build tolerance with adverse price action. So the best case scenario for entry is not necessarily the optimal training point for that exercise. You have to get in the move towards its last piece of where, I guess, in In a sense, yes. Okay, let's agree on this. Buying it here is chasing price if you don't use the context of what we're doing here, which we're doing an exercise. Everything that I'm teaching is promoting the idea of allowing yourself with the right trade idea and direction, because most of you, if you've traded at any time length at all, you have been in winning trades before, but you've gotten shaken out of it. And this is one of those skill sets that you develop by doing this very exercise right here. And this is what you get. So now we can move our stop up. We do not want to see the trade come back in below our entry. So we've done a profitable exercise here. We've shown the effects of what institutional order flow will do with proper context and price action, understanding the daily range, understanding how the orders will be picked up, and then defining parameters what would be intolerable. Like, in other words, we didn't want to see it trade back below here, but we were allowing it to do so. So it could trade down to that price point, that's fine, but anything below that would be not so welcome. So I'm going to watch to see if we can hit that 25, and if we do, I'll take something off there. We'll take 3 off at that price point. Okay, so we traded to the 113.80 institutional level. So we can bounce around in here, let them collect more orders. Again, there's going to be a lot of transactional orders that come around those levels, institutional 80s, 50s, and 20s, and 00 full figure levels. So when we trade to those price points, it's normal for it to sit there and gyrate back and forth a little bit in here because it's collecting orders. They want to, like, the algorithm allows, not all the time, but generally when it trades to it, it allows time for transactions to come in and build more order flow, and then you'll see it expand up to the next level, either the big figure and maybe you trade through it. So I didn't mention it when we did the outline for the framework for this trade, but if we trade to the big figure, what does that bring into the mix? Again, another 30 pips sweep higher. So this idea, even though it's an exercise, you could manage this to the point where, okay, you want to take something off when it goes to 30 pips, or you can open your take profit. Now notice what I'm saying here. I'm not opening our stops for wider risk. I'm opening up the potential to collect more targeting or upside potential because we're factoring in the likelihood of trading to the big figure 114.00. So all of these things are profitable endeavors for you if you do the exercises, but I can't do them for you. The benefit comes by you actually engaging with it. Let me take something out here. Okay, so we have funded the trade. There's 0 opportunity for this thing to show us a negative endeavor. And now we'll go back out to a 15-minute time frame, and you'll see everything in context now, as I outlined it, pretty much is panning out. So it's not a matter of, initially when you first learn from me, it's not, okay, you teach precision concepts, so therefore get me in at the lowest low so I can have a 5 pip stop loss and a 1,000 pip take profit. You know, and that's exaggeration, I know, but nonetheless, precision comes by doing what I'm teaching you here. You have to get past these psychological barriers, which are going to be, number one, impatience, And that's just what we're teaching here today. And you have to overcome intolerance. See, you come into this business with a level of intolerance that you really don't know that you have, because you think that if you watch a video of mine or watch someone else teach something, maybe you bought a book or you bought some courses or whatever, or someone's actually sitting down with you and trying to teach you something, that may not be that their system is bad or their method is bad, even outside of what we're teaching here from my content. They may have a sound approach. I'm not judging that. But what that teacher or that mentor may be lacking in their experience as a teacher or educator, there's certain factors that the human mind builds in as barriers. And those barriers are, number one, again, the first one on the list is patience. You have to be patient. If you're not patient, you're not going to be able to do this. It's as simple as that. Now, if you're impatient right now, that's fine. Those things can be overcome. They're not roadblocks in a sense, okay, or iron walls that are before you. They're just simply speed bumps that you either have to, number one, identify that you have that issue. And everyone has. When you first start, everyone has impatience, because you don't know what you're trying to do. You don't know what you're looking to get to as far as an objective. You just want to make money. Okay, that's what this is all about. You're here because you want to learn how to make money. And I told you when you signed up, I'm not teaching you how to make money. I'm teaching you how to read price action. Now, what you do with this information may translate, and I'm going to press that again, it may translate into you making money if you do these things with a live account with your own decision making, not me telling you what to do. But I can tell you this, you will not make money consistently if you don't overcome the mental barriers that traders invariably have coming into this. Because you're uncertain about what you're doing. You don't know what you're looking for. No one teaches this level of price delivery nowhere. They don't teach the dynamics of it. They don't teach you the components of when the markets should move, why it should move, and where it should never go outside of. I can create an idea on building a model that you specifically and uniquely have yourself. But you have to do these exercises, because if you don't do them, number one, you're not going to have faith in what you're studying. If you don't have any faith in it, obviously what's going to happen? You're not going to stick with it. So there's going to be days when you do these exercises where the price will move outside of the range, and it's going to be viewed initially right away, this is unprofitable, this is a waste of my time. No, because trading is not 100%. I don't trade with a 100% accuracy, even though I've showed months of it on Twitter with one single account over and over and over again. That's my best time of the year. That's all that was, and it was scalping. And many of the things that I did in that account is what I just showed you here. I outlined it before the fact, told you what we were expecting to see, the framework, that quickly. That's all it takes for me to look at the chart and right away know where the open float is, what they're going to target, and it gives me a context of the market. So now I have a premise, an underlying premise of what the market may do. I don't need the excellent, perfect entry point. I don't need that. And that's what I want to teach, especially because we have a large influx of new traders and new students coming in. We don't need the best entry point to have a positive experience in learning. And also, if this were a profitable, if it was a live trade, obviously no one could argue that this would be positive, because we've seen price action move in our intended direction. The downside was completely capped in terms of modesty. There was very, very little drawdown from the point of entry and to where we took our first profit. Notice the sudden movement to liquidity in here. That's reasonable, that's expected, and we're trading around that 80 level. We're just above the 80 level. So again, that same element of holding around that same level. Right now, if this were a live trade, you probably would be thinking, man, do I get out of this trade? Do I hold on to it? What do I do? I've already taken first profit. I've moved my stop to no loss. In other words, we're positive 1 pip. We can't, let's be honest, it can do anything it wants. It can gap down here for real, and it would still disregard the stop. But we have done everything in our human capabilities, okay, within reason, on how to control the risk. But the risk is always there. If you're in the trade, whether you have a stop loss in it or not, you have inherent risk. It's there. The stop loss is your only shield. This exercise teaches you, even if we get the worst case entry point, top of the range, it's not chasing price if we incorporate context. It's not retail trading, because we've understood with a great deal of detail, at least I've made an attempt to do so here, to outline what the market is going to do, why it's going to do what it's going to do, and why it should trade a specific characteristic or style within a predetermined range. Now, from the free tutorials, everyone learns that this is a bullish breaker after it trades away and comes back down. You do not need that if you understand context. We can enter before everyone else is going to wait for that retracement after it trades down. Sometimes that works, sometimes it doesn't. And again, if price trades back down into this, that would be permissible. But at the time of the day, notice what I'm saying now, this is important. The time of the day is really into London close. So I do not want to see price trade back down to this level here, because the likelihood of it coming back down here, and then at the time of day we're at now, to see another level of expansion to clear all this range again and go higher, it's less likely to do it. So we're towards the end of the battery life, if you will, for this particular daily range. So they're going to want to hold it up here, or just continuously press a little bit deeper and maybe attempt to get to that 114 as we go into noon time, New York. All these things come by way of experience, and you cannot learn them and understand them and fully appreciate them until you do these exercises. Every single trading day, I do these exercises, whether I'm executing or if I'm in my head saying, okay, I would do this, I would do that, and I make a little scratch notation on my phone, or I make a little scratch notation on a piece of paper, that I'm sitting next to while I'm doing other things around the house. I may be answering emails with other folks in the mentorship or even free members. If I look at the chart and see something, I immediately write down what I think. Basically, what I just showed you here, and I'm talking a lot because you have to learn what I already understand about why I'm doing it. But you're not having to do all this mental acrobatics when you do the exercise. It's as simple as what I just outlined. But I'm giving you the things you're going to encounter from a psychological standpoint, the impatience of when is it going to move out of this range? When is it going to move in my favor? Oh, it's pulling back against me. It shouldn't do that. I should get out of my trade. And many times traders, if you're in a trade, you'll drop down to these lower time frames and you start seeing this was my entry and it's trading all the way down here. Man, it's going to keep going down. And what do? You bail out right there. And then you see this move, and that's demoralizing. Let me tell you something. In the 90s, I did that a lot. That happened to me a lot. It shook me out of the trade because I didn't have a built-in tolerance to adverse price action. You have to have these skill sets in your development. If you do not have them, or if your educators or gurus or teachers do not teach these things, you're not learning how to trade. You're not. You're guessing. You're being taught how to guess. And I don't teach guessing. I teach statistical probabilities within a reasonable context of time and price theory. And it's an algorithmic perspective that is proven every single week. Every single time I sit down and explain something over the chart, it pans out to script. So either I'm controlling price, and my hand to God right now, I'm not controlling price. I get a lot of people, they'll make comments and such thinking that I'm doing that. I don't have any physical control over price. I can't do that. But I can read what price may likely do. Just like we did here. We outlined why it should pause and hang around this price level and then resume going higher. That's a reasonable expectation based on what I teach you in the mentorship. This is real institutional order flow. There's no volume profiling thing over here. There's none of that stuff necessary. None of that's necessary. You don't see any charts in here. Only thing I'm drawing is a horizontal line and a range highlighted with a box to show you context. What's inside this box? Okay, what am I considering? What's inside that? Well, that's a dealing range, a 15-minute breaker. So we can see it trade back down inside that range and still be going higher. But if it's going to go down inside that defined shaded area, what is it going down for? Well, we've already arrived at that. We have a bullish order block, then we have a propulsion candle. Propulsion candle rules are we can't go below 50% of that. It's a here. We dip into it right here one more time, reclaim bullish order block, bang, takes off. We've defined an area right here. And right at this moment when we defined that, we could have really essentially moved the stop up a little bit from there. But because I'm trying to teach you as the market is doing what it's doing and show you that I absolutely know what I'm talking about, I have very little time many times to try to get my point across before the market does, before I have it in my mind to tell you what it should do. I have to make sure I get it out. So it's a very dynamic way of teaching, obviously, but you would expect that from someone with a braggadocious attitude like I do. I know what I'm talking about. I know what the markets are going to do. I already know what you want to know. I know those things. And I do these things just to, one more time, to slow your roll, calm you down, make you understand that you're in good hands. I didn't just start doing this. I've been doing it for a very, very long time, and it is beneficial for you to just relax and allow yourself to grow. Right now, we are in London close. Essentially, this is like the take profit time of the day. In here, we really don't want to see it give up anything. Like below here, it could run those as a stop run, and I'd like to see it continue there. But again, so late in the day, probably wouldn't be that energetic once we take these lows here. So in other words, everyone else has taken their stop loss and jammed it right underneath that low. That's not, in my opinion, where they should have moved their stop. We have removed the tendency to want to move our stop up like that because we've taken first profit. So the exercise is I'm building tolerance to being in the trade, even though it's not moving in my favor right now, and I know that it could potentially run these stops, and we do have a void in here, but because of time of day, I don't think that it's likely to sell off that much to come back down to that level. They're going to want to try to keep it near the high of the day. What is that? That is power 3. So power 3 components, coupled with the actual time of day and what has been shown in price delivery here, we're inside of this large liquidity pool. If we zoom out a little bit, again, we're well above these equal highs and above these equal highs. All this price action in here, this is not, in my opinion, a sell signal for it to come down here before like 1 o'clock today. In other words, in the next 2 hours, I don't reasonably expect it to be down here. Now, can it do it? Absolutely it can. But because it happens outside of the time frame that I'm in the marketplace, it's insignificant to me. So when we operate with elements of like defining our daily range and working within the context of entering, as long as we have time before London close, and then or true day, which again is taught in the mentorship, those boundary points in terms of time, who cares if this fills in later on after 1 o'clock in the afternoon New York time? It doesn't make any difference to me, because all I'm trying to do is capitalize being from here up in here. And watch it. We'll see if we can get that. We're on here and see if it wants to maintain that range. If we look at what we have, we also have another smaller little dealing range. So we have this low to this high. So this is our present dealing range. All we're doing right now is trading at the equilibrium price point of that. So this is reasonable. This whole retracement back down, it can sweep below that and still continuously move higher. Maybe not today, it could just probably hang around in here. And then during Asia, it may want to resume and go higher. Or London may want to go higher. But we're watching to see if there's any sensitivity after it takes these stops right below here. For anyone that jammed their stop loss, there's really essentially they're probably stopped out now. But we want to see if there's any willingness to rally and continue higher after that low. Okay, so we don't need this level anymore. It's expired. Okay, so those stops have now been taken. I want to see if this candle can turn green and reject in here. You may want to go a little bit lower than that, but we don't want to see it trade below this down close candle, the body. So those stops are definitely taken now for anyone that's trailed it. So they've only been limited to whatever they caught as an entry down here to here. If it's going to continue higher, this would be the ideal scenario to do it. Once it runs the stops and then start to move higher. But again, probabilities are so low because of the element of time. We've already hit London close. So the battery life is really, really low at the moment. Okay, so we traded through this bullish order block in here. Not good. We traded through the body of that. So this could now give up all that range. In this instance, I'm going to bail because I don't want to see any of that range close in because the probabilities are now so slanted against me. I save the full stop out. I have data to work within. I'm not concerned whether or not I'm making money or losing very little. The outcome is what I wanted to see. I wanted to see the dealing range in here, support price. I wanted to see price move to the upside, run into the open float buy side liquidity as outlined on the 15-minute time frame. We reached up into a level of the institutional 80. We spent some time around in there. We traded back down to the bottom end of that new dealing range. And we'll see if it wants to stay in this range or come all the way back down and close in this buy side imbalance, sell side inefficiency. But because of time, and the time is at the moment basically 11 o'clock. So that's London close for me. It's like the heart of when you want to be out, but you obviously want to look for price points to reach into going into this hour between 10 o'clock and noon New York time. That is your profit-taking window, if you will. So back out to a 15-minute time frame. This is what we have. All the elements that were shown beforehand. We didn't get the 20 pip sweep or the 30 pip grade sweep. It could still do it. It may take a little bit longer time because Euro's really been held in consolidation. If we take a quick gander over at the cable, you can see that it has topped out for the day. And Euro made an attempt to get up there and try to close some of that gap between its performance relative to the British pound. Dollar index, wouldn't you know it, we traded back down into this fair value gaps. It's outlined here. And everything for this exercise pretty much panned out in a profitable sense for your learning. So we have, this is a new demo account I'm testing through it. Ava Trades, I think is what it's called. Come on. So there's that. Not over leveraging, obviously. It may have seemed like it because I put 5 lots on, but relative to the equity base, it's nothing. It's very insignificant in terms of risk. But not many people can say they would make this much money in one single day in less than an hour's time. So we had dollar reach down into our fair value gaps. We had buy side imbalance, sell side inefficiencies denoted perfectly beforehand. I told you why it should go down there, and I also told you why the euro should go up to where it went to. It did not go to our second target. It's not necessary to go to our second target. Those targets are incremental. Okay, they are going to be subsequent to a previous level being reached. So we had our level 1. We hit it. I took profit. I took the bulk of it. Now notice what I did. I had 5 standard lots on, and I took 3 off at the first target. Why did I do that? Because we had very little time relative to London close time parameters. Now, if this would have been, for instance, 8 o'clock in the morning or 8:30 in the morning when it started to surge up like that, I would have not taken as much as I did. I would have just taken off one standard lot, left 4 on, try to reach for the second one, because we would have more time of the day to see these other objectives be met. But because we had very little time left in the daily range relative to loan and close, again using the kill zones in context, it allows us to frame out protocols. Now, you need not do what I just did. You may want to say, well, I'm just going to take off half, and then I'll half it again. And that's fine. There's nothing wrong with that. There's no, this is the best way of doing it. It's going to be a matter of your personal risk tolerance and what you feel comfortable doing. As long as you're taking off something at a logical level that you had a predetermined notion on it being an objective, and you execute on that, that's where consistency is birthed. You find consistency by doing that. Now, over time, you will feel less likely to want to take partial profits because you'll feel more confident that a specific level will be reached. Even though initially when you look at the setup, you'll say, okay, well, this is where I would used to take a first profit, but I'm fairly confident it's going to go to level 2 target. So you wouldn't take that first partial profit. You just sit there and you wait. And then that in itself is going to have a tolerance level that is needed, and you get that by doing what we're doing here. So the way you take this exercise and you build on it is, if you have multiple targets, try to hold the trade beyond first target. Don't take first profit. Reduce the risk, but don't take first profit, and then try to reach for level 2 targets. And once you do that for a little while and you build experience doing that, then do the same thing for level 3 targets. Reduce the risk and then hold out for your third target. Again, the expectation is it's not going to always do it, but you're building a tolerance to the effects of being in the trade, engaging with price action, watching it move and breathe. Once it's doing what it's doing after you enter the trade, that's where the real work is. You're all thinking it's the hard part before you enter the trade. Where is it going? Where should I put my stop loss? How much should I buy or sell? When's a good entry? What should I be doing before the trade? You're worried about all that. And I'm telling you that that's the easy part of it. The hard part is what I'm showing you here. This is where the rubber meets the road, they say. You have to have experience. You got to know what to expect because you've been involved in it multiple times in similar conditions. If you don't have that, it's going to be very hard for you, and you're going to struggle mentally, and you're going to get out of trades that are really still good. There's nothing wrong with this move here as we outlined it. And I'm going to show you again with the tracers. We'll put them on the chart. Okay, and we'll put it on a 1 minute chart. You can see just how much drawdown was incurred on it. Let me take this away.